Thanks for tuning in to today's podcast. Please remember that all of the information in this podcast episode is limited to general information only. That means the information is not specific to you, your needs, goals, or objectives, so you should seek the advice of a licensed and trusted financial professional before acting on the information. And before you acquire or apply for a financial product, please read the PDS or product disclosure statement, which should be available on the issuer's website. Lastly, please keep in mind that past performance is not indicative of future performance. Luke Winchester, thanks for taking the time out to join me on the podcast, mate.
Thanks, Alan. Yeah, cheers, mate.
A lot of people know you on Twitter. People follow you on Strawman. And people now are getting to know you or already do know you from Oracle Investment Management, where you're the portfolio manager of the merging company strategy and fund. So there's people out there and people listening to this that have experience with you and some of your work, and I'd encourage them to go check you out, whether that be at Oracle or even on Strawman. I'll provide both links in the show notes. But we're going to talk about small caps. We're going to talk about a bit about you. We're going to talk about how you get an edge in small cap investing, why you like it, the difference between managing money personally and professionally. And then we're just going to settle in with some sage advice on the end. But why don't we just kick things off? As you know, mate, one of the things I like to do is just like to find out about how you got started in investing, kind of where that journey began.
Yeah, sure. So my start to the industry is probably a little bit different to most who come on the podcast. I've got no formal background in finance or commerce, no family history of investing. As far as I know, I'm the first person in the family to own shares outside of super. Originally I studied business at university and found my way into industrial relations actually at the time. Travelled around a bit to Port Macquarie and Melbourne for work in that space. And then my journey into shares actually started in a way I guess a lot of listeners may relate to, and that was I watched my friends make money. Back in the day, around 2011, 2012, in the mining boom, and a few of my mates were, making money and paying for holidays on the back of gold stocks and who knows what else. So, it was that classic greed and envy that sort of got me started into shares. I didn't realise that, that sort of money could be made and seeing mates pay for holidays and who knows what else on the back of tips off hot copper and things like that. So that was my introduction to shares. And so, the first shares I ever bought, I do know the names of them. It was Axiom Mining. The ticker was AVQ for that. I went back and had a look. It's been suspended for many years now. And the other one was Avanco Resources, which in the end got bought out by Oz Minerals, but it was a wild journey on that ride, and I was exited well before that. But yes, Axiom Minerals was a tip from a mate. I'm pretty sure Avanco was the most commented stock on hot copper at the time, which is how I got involved in that. And so that was my introduction to stocks. It was very similar to what you see today with Reddit and Wall Street bets. It was just obviously it was the mining boom at the time. So it was social media. It was mining stocks. It was pumps and dumps, and I was in the thick of it. Now, I look back at that time and I can only consider myself lucky that I started back then with $1,000 in a CommSec account and the minimum $500 parcel in those two stocks. So I learned my lesson very quickly, very early on. I very quickly lost money in both of those stocks. But even through that experience of losing the money, I quickly found that I enjoyed the idea of owning shares. I think even back then I understood intuitively, you were owning shares of a business. I was just too naive and green, I guess, to realise what sort of businesses I should be owning. but I stuck to it, and so like I said, no formal education or training. I was so new to it all, um, and I found myself on Hot Copper, and I found myself searching around, and I found a handful of users who I would follow their posts and follow the stocks they were following, and they were doing well. They were making money, and so I tried to jump onto the back of that, and more than just follow their stocks, understand what they were seeing, read their posts. Um, and one of those posters went by the nickname of Stweeve, who I now know Stweeve quite well personally, um, and he was influential in starting a Facebook group. So I found my way to this Facebook group, and I think that's where it opened up a new world of, hold on, there's a lot more to shares than just specky mining companies. There's a lot of good businesses, a lot of good small caps, and some of the people putting research on that Facebook page back then, these were still some of the smartest investors I've ever come across. They were just private investors, but they were unbelievable, and so I threw myself into that, and it was reading these posts, reaching out to these people, becoming friends with them on Facebook, talking to them, and starting to build up this network of people. And at the time, I probably didn't realize the importance of that, but sitting back now, playing in the small cap space on the ASX, it's so important to have that network of people, because you don't have broker research, you don't have industry coverage. It's sometimes very difficult to get in touch with these management teams the same way that you would with larger management teams who are hosting, webinars and things like that after all their reports. And so it's important to build out that network around you and always be talking to people and finding new ideas, bouncing ideas off people. So I found myself doing that almost by accident. And after a while, I thought, okay, I'm getting confident here. I'll try posting one myself. And so I actually remember the first post I ever did to this Facebook page. It was for a company called Senitas Corporation. They're still listed.
Mm.
SEN is the ticker. And I remember even back then, without knowing as much as I know now about research and the stocks, I sort of saw the opportunity even back then. I tried to find the post. I actually couldn't find it, unfortunately. I would have loved to go back and read it again. But it was, a few hundred words, and it was what the business did, why I liked it. It was just that classic thesis. It's essentially the same thing I'm sort of doing on Strawman today, which you touched on earlier. Um, but from that, a few people reached out to me and sort of said, "Look, I own Senitas. I like it too." And then, a few weeks or months later, I think they reported quite well, and the stock shot up, and I started to see the value in, okay, well, if I'm putting things out there and having it critiqued and engaging in these conversations, I'm seeing the benefits of being able to filter down to better businesses, invest in those better businesses, and hopefully make money. So it was good, the same way I had the negative feedback from that start originally in the specky mining companies. It was good to get the positive feedback of, okay, well, when I put in the work and I do the proper research and have conviction in myself, it was good to see that play out on the positive side. Um, and yeah, from there, like I said, I slowly built out the network. I then started to try and post research sort of wherever I could. So I was on Hot Copper for a while. I've actually been banned on Hot Copper, so I haven't been there for a few years now. That's no great loss to me. But I remember I was posting on a website called Share ID, which it only ran for a couple of years. It was run by a
Mm.
bloke called Alex. I can't remember his last name. Sorry,
Alex Hughes.
Alex Hughes. That's right, Alex Hughes. So Alex started that website and ran it for a few years. And I posted an idea on there for rectifier technologies, RFT,
Mm-hmm.
and very similar. Like through good fortune, good luck, or good work. I'm not sure how you would weight those three things. It did well, and so again, it sort of was a sort of again just getting my name out there, and having people sort of recognise not just me but the work I was doing, and putting it out there. Um, and yeah, so
Mm.
that just snowballed into a few other things, and it's probably culminated now with I find myself mostly on Twitter and Strawman, but it's that same idea. The concept hasn't changed. It's I do my work, and I don't put it out in the public domain for I'm not trying to pump and dump my stocks. I put it out in the public domain to be critiqued. I still talk to people, and if I find out, they've spoken to a management team of a business I own, or they've looked at it, I want their honest opinion. What did you think? What do you think I've missed? What did you like about it? What didn't you like? Because no matter how much work you put in, someone can always bring a new perspective, or maybe they've just asked a question in a different way to management to get a new answer, or something like that. So it's always just about um, really trying to get as much information as I can about the businesses I own or I want to own, and that's positive or negative. So yeah, that's where the path has sort of led me to now, on the personal side of things. But yeah, I was then able to sort of move that into a professional career as well.
Hmm. So did that come about as a result of, people seeing you post online, or how did that come to be? Or did you just apply like a standard, you know,
Yeah,
application?
no, it was just a standard application. I actually missed it. I was working in industrial relations,
Mm.
but by then I'd been personally investing for probably 3 or 4 years, and doing quite well. Um, and one of my mates just sent me a CCAT on a Friday afternoon, and he said, "Oh, look, it's actually closed. I actually missed the cutoff date." He said, "Did you see this?" I said, "No," and it was a entry level position here at Oracle. Actually, at the time, we were named Farnham. We had a name change, but
Mm.
yeah, it was an entry level position. And I thought, well, at that time I was in industrial relations, and I enjoyed the work. I really did. It was, very interesting and varied stuff. But you know, even then, I could tell that I wanted to move into shares, and not so much from the professional view of you know trying to make money out of it, but it would just open up more opportunities for me in the sense of access to people, access to resources, um, access
Mm.
to, I guess, I was still very green. I didn't really know how institutionals approached shares from the sense of modeling shares, reports, committees, things like that. So I was also interested in that side of things. Anyway, so I just applied for the job, and yeah, I submitted. I think I submitted my the share idea article I wrote on Rectifier Technologies, and I may have submitted another one. I think I did two. It escapes me what other stock I may have submitted, but it was just my a few hundred word write ups. And yeah, I was lucky enough to get invited in for a bit more of a chat, about what I was doing. And part of that chat was, look, this is entry level. I'd sort of worked my way up in the industrial relations space, and it was sort of, do you understand that you're taking a real back seat? And I did, and so jumped at the opportunity. And yeah, look, those first couple of years, it was actually quite good for me, because I was despite being older, I was 28, 29 at the time. Um, just not a graduate fresh out of uni. I didn't have any of that background. Like I said to you earlier, I didn't have a commerce or finance background.
Mm.
It was also new, and so having that entry level start, it sounds basic, but I was learning about literally how to place trades, settlements, some back office stuff. Building really simple models, sitting on committees, and just I was the person that took the minutes. But But just getting exposure to that institutional way of thinking, um, it was really valuable at the time. And I just slowly over time, this was always the plan for the role, was to slowly just ease into the analytical side of things. And so I did that as well. And um, I actually remember my start here at Oracle. Unfortunately, wasn't as successful as my starts with Senitas and Rectifier Technologies, because I think the first stock I pitched was Bellamy's, and this wasn't Bellamy's when Bellamy's was $1. This was Bellamy's. I think it was about $13, $14, and then they, a few months later, had some issues around their inventory stock and things like that, and very nearly went under. I think sort of gets lost now that they managed to get out of it, but I think they were a lot closer to bankruptcy to what the market or what people probably realise, but that was also a lesson in itself. I mean, the same way I lost money on those mining stocks early in the day, it was a good lesson in, uh, for me at the time. I probably got a little bit lost in trying to stick to an investment philosophy that I was new to. So at Oracle, like at most places, we have our checklist of what we look for stocks, and so I was trying to put the round peg in the square hole of, I was only looking for businesses that ticked every box on that list, because I didn't want to come to the committee with, it doesn't meet our debt filters, or it doesn't meet our return on equity or our growth filters, or whatever it may be. I wanted that investment that ticked every box and did all that. And so on its face value, Bellamy's did that. But I think what I sort of missed was that next level of analysis on the qualitative side, rather than just the numbers, about what were those forces impacting on the business, and it was there if you wanted to do the work, and that was the real thing I took out of that. But yeah, look, I obviously stuck with it. And I was an analyst for a while, just floating across. We run a few different portfolios. I was just floating analyst across a few different things. But about a year ago, as you sort of introduced me at the start, I was appointed to portfolio manager of our emerging companies, which is our small mid-cap portfolio. And I've been running that for just under a year. I think it was pretty much COVID was my feet to the fire when I first took over. I was very familiar with the portfolio, but officially taking over was in that peak of COVID.
It's a fascinating story. I'm reminded of something just from your learnings through social media and the like. One of our analysts said to me recently that he learnt more following people on Twitter than he did in his master's degree. It seems to be a recurring theme. If you find good people to follow, you can kind of just soak up the wisdom from them. So one of the things that we talked about just off air briefly before we hit record was this difference between the Luke, the private investor, and Luke as a professional investor. This is something we don't often talk about too much on the show. You said, 9 to 5 is Oracle, and then you do a little bit, when you can, for your own stuff online. What's a typical day look like for you now? And I guess what's the contrast between like the way you invest personally and professionally?
Yeah. There's not too much of a contrast in what we're looking for. I mean, from a philosophy point of view, you know, uh, my personal philosophies align 100% with Oracle. It's just the space, that
Mm.
we tend to play in. But yeah, to sort of rewind and answer your question, I've got a 1-year-old and a 3-year-old, so my day typically starts whenever they want it to start, um, and so in between making breakfasts and getting everyone sorted, I'm trying to sort of just check my phone and get a feel for how the US markets were last night. Nothing too specific, just any major news, because it's going to impact me in some way, how
Mm.
the US performed. Um, but yeah, look, once I'm at work, I am on Twitter, and to go back to that point you made, I mean, if there's someone out there who doesn't have a well curated Twitter timeline, you're behind the eight ball. It's to me, it's turned into my most important source of maybe not financial information, but certainly financial analysis. And
Hmm.
you have to curate it yourself. You have to find the people. I think I've got about 180 people that I follow, which I find is a good number to sort of keep up with. Um, but the people you can find, and sometimes they're professionals, they're fund managers, other times they're just private investors. But as I alluded to before, there's private investors out there who I would put them up there with any of the fund managers I've come across. They are geniuses. They just don't want to manage public money because
Mm.
one, they don't have to, and two, they don't want to.
Yep.
But they are geniuses, and they often just put their thoughts out there to the public. But more than that, reach out to people. I know for me personally, if somebody sends me a Twitter message or a DM, I reply. Like, I want to engage with people because, particularly in the investment space, in the small caps, you need to engage with people because it's your best resource. You can't,
Mm.
if your universe is 200 or 300 stocks, you can't be across them all at one time, but you can develop a network of people who you trust. And not to say you blindly follow these people into investments, but if they have a good idea, you're having a look at it. If they bring up a red flag for something you own, you're digging into it. So Twitter is big for me. I almost I have it up in my Chrome browser. I think all day at work. It might close sometimes, but essentially it's always open because when either it's breaking news or just keeping a track of that analysis, it's always there first. So Twitter is big. And then the other thing I do is I literally read most announcements that get released on the ASX. Outside of reporting season, that's not too difficult to do. There might be, 50 or so a day. I don't really dip into mining stocks or biotechs, and neither does Oracle. So, putting them to the side, it really reduces that universe as well. But even during reporting season, look, you've just got to do the work. I say that to people. Um, so, as an example, quarterly reporting season, I open up every 4C of a business that's not a mining business or biotech, and you quickly learn which tickers are which. Over time.
Do
Um,
you look? How do you keep track of things? So, once you read them, do you have a database or some type of note taking system where you kind of collect your thoughts?
Yeah, yep. So I keep a watch list in. We use Iris here at Oracle, so I've got my Iris watch list set up, but I've got a spreadsheet as well with little notes that I keep. So the watch list has, I haven't probably counted for a while, maybe 90 to 100 stocks on it.
Right.
And that's just things that, and literally, so that process will be, like I said, I'll open up literally every single quarterly report that's not a mining or biotech, and I'll just have some key things I look for. So cash flow positive is a big one, if not close to it. Growing receipts, that's probably the start there. And if I like what I see there, I might move to some commentary. If I like what I see there, I might go back and look at some older reports, some investor presentations, and annual reports. And again, if it continues to look really interesting, I'll throw it on my watch list. And
Mm.
then at some point, I'll try and delve a bit deeper into it when I find time, or just as maybe as new announcements come out, or the next round of reporting season is now on my radar. But yeah, no, I think it's important to build up your knowledge of the universe you want to play in. And look, just because I don't invest in mining stocks, I'm not saying you can't make money there. I know a lot of people that do. You just got to know your circle of competence. That's the classic, the
Mm.
classic sort of saying. But once you do, you can filter down the universe that you want to play in. And so I do that. And like I said, I've been doing this now for 8 years. Over time, like you very quickly learn the tickers and the names of all the stocks that sort of you have an interest in, and it doesn't take long. I mean, it sounds like a long task, but it's you can sort of keep up with the day each day as they report during quarterly reporting season, or half year reporting season, full year reporting season. Um, and
Mm.
yeah, look, I think it's a very important thing to do, to build out that watch list and that knowledge, and it comes over time. It probably is a bit daunting if you're starting fresh, but it certainly does build over time, and I think people would be surprised at how quickly that knowledge builds, particularly if you're supplementing it with other people, whether that be Twitter strawman or something like that.
Mm.
Um, yeah, but look, I mean, from there, the process is very typical of, I guess, any other guests you've probably had on here. Um, you're going back, reading reports, getting a handle around the business. I do like to speak to management. Some people don't avoid that, but it's not a necessary thing for them. I do try to speak to management. The one thing I'll always do is I will do the work before I speak to management. I found that one of the major pitfalls people can fall into is, if you haven't done the work into a stock before you speak to the management team, you're very susceptible to the narrative that they want to spin about their
Mm.
business. And I don't want that to come off in a negative connotation. Although there are some managers who probably
Mm.
should, that should apply to them. But keep in mind, these management teams, even if there's nothing untoward, it's their businesses, it's their livelihoods. They want to be positive about the business and its outlook. I mean, I don't think I've ever spoken to a manager who said to me, "Yeah, this is an average business that's going nowhere." If it was, they wouldn't work there. So inherently, they're going to be positive. They're going to be, they're going to tell you all the great things about their business. And if you haven't done the work into that stock to be able to drill down to the potential negatives, or to keep your feet grounded from being, lifted up from the positive spin that they want to put on it, you're going to find yourself caught up in that. And it's crazy, because I've had it done myself. I know from experience. The big one that got me, I'll give you the example. The big one that got me personally years ago was a stock called MSL Solutions. The ticker was MPW, and that was one I just, hands up, I just didn't put enough work into it. I listened to management present. I read the investor presentations. And to be honest, I was very lucky that one of my colleagues here at Oracle was almost the rational voice that I needed to hear, who kept pointing out to me every quarterly report, mate, the cash isn't coming in. you know,
Yeah.
the ARR is being touted, and the revenue and the customers. It all sounds good. But he said there's no cash. And it
Mm.
took a while for it to click with me, because I was blinded by the story that was spun, and I was calling management, and being told, oh, this, yep, all this looks good, and we're about to win this and do that, and whatnot. But yeah, I was quite lucky to get out of that before suffering anything too material, and I've sort of kept half an eye on the stock. I think the management team from back then's actually departed, and there's a new management team in there. But it's a very important thing that I don't think gets discussed a lot. I think when people talk about talking to management teams, I don't really hear that sort of point really being discussed, and I think it is really important,
Mm.
because you can really get that bias without even realizing it. And I think that's what's dangerous, is you don't realize the bias that's been put, into the back of your subconscious. And the only way I think you can really manage that is to go into those meetings with maybe not an in-depth, super in-depth knowledge of the business, but at least a knowledge of the potential negatives, or some questions that can sort of get direct management into that when you speak to them.
I've found there are kind of two types of people that interview management, and one would be the more abrasive type that asks really hard questions and wants to kind of grill them on points, and then there's the one that is a bit more flexible and kind of chummy with them, but in their own mind makes up their own mind if in their own time, if you like. And I'm definitely not one to be too abrasive with management and not to really grill them on things, but I just try and lure them into. It sounds quite bad now that I say it on a podcast, but I kind of lure them into to saying things which they think I want to hear, and that kind of reveals who they are. And I think we've had Matt Joss on the program before, and he said something similar. Is there anything that you ask management in particular, or can you think of any examples where you've had to use your own kind of persuasive interviewing skills to get to the truth?
Um, there's probably not, one or two specific questions that I ask to each management team. It is very much depends on the business and the management team themselves. I think it's a very good point. I actually agree with you that you generally fall into one of those two camps of you're I'm going to stand away from you. I've got my list of questions. You have to answer them. And then there's the people who are much more, let's have this conversation and build up a relationship. And it can often depend on the manager as to which is the best
Mm,
approach to sort of get the information you want. I mean, look, there is one question I do tend to ask in every conversation I have, and that's something along the lines of, uh, from my point of view as the investor, outside looking in, what's something I can do to track the business or track your performance? Like what's a benchmark that you're measuring yourself to? And sometimes that's
mm,
as simple as, we're chasing revenue growth. Like that's the phase of the business that we're in. So, we're measuring ourselves by our revenue growth. Um, but the best answers are the ones where it's often something more strategic. It may be a smaller segment of the business that's growing, and they're saying, "Look, we've got our core business doing well, but this is, if this side business or new venture that we're getting into, we're really excited about this, and this is what we want to see grow over the next few years." Then that's something that you can look at when the reports come out. While other people may be focused on the numbers being driven by a core business, you may have an insight. Well, actually, management's really excited about this new venture, and it sounds like it's doing really well. Um, and
mm,
so, I know for me, specific examples. I guess one that maybe comes to mind there is a business I've held for a long time. Is a small business called Laserbond,
mm,
and I remember the first time I ever spoke to them. So those guys. Their core business, in going back to that example I was just talking about, their core business is surface coating for heavy machinery. So they apply a microscopic coating to the surface of heavy machinery, which extends the wear life. So their core business was a mining contractor will send them a large drill to their factory in Western Sydney. They coat the drill, send it back, and it's a very good business. It earns decent returns on capital and all that. But I remember when I spoke to management at the time, they were really starting to ramp up what they call the product side of their business, and it's the same. It's the same. It's the same like idea. They're surface coating products, but rather than doing it for people sending it to them, they're doing it for the OEMs. So you have these original manufacturers surface coating these products before they go to the end customer. And it's higher margin. It was the potential for higher growth. And so, chatting to the management team, you quickly understood that this was their big focus. The services business, it was established. They've got a good brand name. It's going to tick along and do well. But this was, the product segment, as they termed it, was going to be that next leg up. Um, and so I think it was their FY18 annual report, and it was almost that exact situation I just described. It was a average report, but within that, the products business accelerated massively, and I think was doing something like 35% EBITDA margin. Maybe that's
mm,
top of my head, but it was, I think services does 20, 25. And so it was that sign. Well, the market's looking at this average result, which was it was sort of dragged down by a weak half in the services division, without noticing that this smaller segment, it was really accelerating. And this was the segment that management was most excited by. So I remember originally buying shares around that sort of situation. Um, and then interestingly enough, I mean, this probably feeds into another thing. Um, we were discussing off air before about one of the things I always like to do is try and find a metric or something that I can track outside of reports and presentations and things like that, to
Mm.
try and get a feel for how the business is performing. And with LaserBond, one of the things you could track was they were exporting a lot of these products to the US, because one of the products was a roller for steel mills. And so there's websites you can go on that track exports. And so literally once a week, I actually just set up a calendar reminder. I think it's like on a Thursday morning or whatever. Jump onto these websites and see whether LaserBond had shipped a new order. Um, and it was interesting because you track it over time, and it gives you some decent details, like even the free versions. You can see who the customer was, the weight of the order that was shipped, and times and things like that. So I kept a little Excel spreadsheet, and you could see these orders ramping up. And then this was a couple of years ago, and then 6 months later they report a bumper number.
Mm.
And anyone following that sort of research or metric, you can see it coming. I think the stock re-rated pretty heavily on the back of it. But it was there. You just had to understand what to look for, and so sometimes you'll stumble across that yourself. But don't be afraid. Ask management. I've done that as well. I'll say to management, like, from my point of view, what should I be looking for? Is there anything I can track? There's some obvious ones. If it's a website based business, track their website traffic. It's easy to do. If it's an app, you can the App Annie is a great
Mm.
resource. For any businesses that deal with government tenders, the Australian government tenders.gov.au, they by law have to put up every single tender, so you can see when Tech One or whoever is winning a tender. So there's all little things you can track, and it doesn't take long. That's the thing. And some people are doing it, but 99% of people aren't. And so if you can be that 1% that's doing it, um, sometimes it may not amount to anything, but when it does, it can be material, because it can be information that the market is really discounting, or not even paying attention to. So it's certainly something I try to do with all of the stocks that I own, whether that's personal or in the Oracle portfolio. Just trying to find, what's one metric, one piece of information that I can sort of track over time to get a feel for the health of the business. Some other examples. I'll come across the Oracle portfolio. We've owned Jumbo Interactive for many years, and I think the market has well and truly cottoned on to this now. But go back a couple of years, I think it was quite misunderstood how much that business was driven by jackpots. And so, we were tracking the Powerball jackpots, years ago, and you could see, like, if they got a string of big jackpots, it was going to be a good result when that was released. Like I said, I think the market's well and truly understood that now, but back then, when there was less broker coverage, I think you could really get an insight into Jumbo. Um, it can even be a great red flag indicator. We owned Experience Co in the Oracle
Mm.
portfolios, and that was a business. They do a bit of skydiving as their core business, but they'd actually expanded pretty heavily into tourism, almost entirely up in Cairns, far north Queensland area. And they put some guidance out in the market saying, some financial guidance, but the assumption to that guidance was 6%, passenger growth, or 6% customer growth through their businesses. And you can track passengers going into Cairns Airport just on the Cairns Airport website, and this is obviously well before COVID or anything like that. It was just when I don't know the timing for it exactly. Oh, maybe
I
Cairns
think.
Airport was going through a renovation or something like that. But you could see the passengers were down 10, 12%. And so it didn't take a genius to realise, well, if Cairns Airport is down 10 or 12%, it's going to be very difficult for Experience Co. to make up that ground and then whack an extra 6% on top. And of course, they missed pretty heavily. And I think that share price, more than halved from 50, 60 cents to less than 20. But
Yeah,
yeah,
you add in leverage and it doesn't end well.
no, that's right. That's right. The balance sheet was obviously was pretty heavily geared, so they had to do a pretty big restructure. But yeah, look, it's just it's just sitting down and, like I said, sometimes you can just ask the management team, what can I track to to try and get a view on the business. But other times, just sit there and think. You know, what is the
Mm.
business? Is there any public available information? The other ones as well, Seek. I have some Seek searches saved for all of the businesses. Not so much the Oracle businesses because they're quite a deal larger. So
Yeah,
those businesses have Seek ads on the run constantly. But for the smaller personal businesses I own, like if they put on a new business development manager, that's can often be a material decision to them. So
absolutely.
it's interesting to track. If they do put on a new sales manager, where is it? Is it WA? Is it a region they're not in? Okay, that's interesting to me. If it's a
Did you,
new
Luke?
product
Sorry,
manager or
can I
something.
interrupt?
Yeah, sorry.
Were you the analyst at asked that on the laser bond call about 6 to 12 months ago?
Yeah, yeah,
Okay, there
yeah.
you
That
go.
was me.
I was wondering. I was thinking to myself, who asked that question?
Yeah,
And that's when I learned I figured out what you were doing, and I thought that's a really good way to get an edge, especially in
yeah.
small caps.
Yeah. So that's yeah. So that I think that was the example I had. They had some ads up for sales jobs in WA, and they've got no operations over there. So to me,
Yeah,
straight away,
right.
I go, okay, that's interesting. Like, what comes of it, I'm not sure, but clearly they're looking at that market and understanding the business, and a lot of their clients are mining, construction. WA is it's a market that
Mm.
could be material to them. So yeah, no, I did ask that question. Um, and yeah, so that's another one, tracking Seek jobs. And a really simple one is use LinkedIn. LinkedIn, I think, has this stigma attached to it for some people who view it as, I don't know what language on the podcast, but wankers on LinkedIn. Just patting themselves on the back. There's the great
Mm.
Twitter account of people of LinkedIn or whatever it's called. I love reading that every now and then. But it's a great resource to track the executives of these companies. And some are more active than others, but the ones who are active, you can see that you can literally go onto their page and look at the activity, and you can see, who are they commenting on, what are they sharing, what are they liking, and again, it's all incremental knowledge where one thing, of course, it's not material and you'd never make an investment decision around it, but it's when you piece it all together. um, and it may be one of these managers, commenting on the post of a customer or something like that. You never know what it might be,
Mm.
but it's free. It's easy to do. It takes, like I said, I set up alerts on my calendar. It takes me 20 minutes, half hour a week just to click through to all of the directors or MD CEOs of the companies, and just have a look. Well, what have they done on LinkedIn the past week?
Mm.
And sometimes as well, if you want to go a bit deeper, um, if you look into the company itself on LinkedIn, it generally has all the employees who have obviously set their jobs to that company. Following maybe a sales manager or an operations officer. There's also value in that too, because they're
Mm.
often your frontline guys,
Mm.
who are doing that sort of stuff.
I found I had to do that with RPM Global, and the reason why is it's kind of on the edge of my circle of competence. But they also sell to mining companies, and
Hmm.
that's not necessarily in my network. So I found I had to follow the BDMs and the tech guys that were working at RPM just to get that insight of who are they selling to, who are they communicating with, how are they communicating it, and how are they growing this business online, like that channel for them. So that was a really interesting insight I got. And to be honest, I find it probably LinkedIn less valuable for like the consumer type products, but definitely for those more corporate selling funnels, I think they're really valuable. One thing that I kind of thought about as you're saying that is, you probably get from. I was trying to think about quantitatively speaking. I was trying to think about how much value do I get from the publicly available stuff that goes into your brokerage account versus these scuttlebutts and these anecdotes and tidbits that you get from around the place. And it's probably that old 80-20 rule. You probably get 80% of the meat from those periodic reports and what have you. And then if you really do the work, that last 20%, although you say it is easy in some respect, you do have to be creative and you do just have to take the time to set it up. And I'd say that's where you get that edge. And when I was thinking about, these rapidly growing small companies, I feel like headcount is one of the most powerful signals because it actually it reminds me of my own business where taking on a person is probably the biggest risk we have in the business. It's the biggest responsibility I have as a manager in a business. And if I was taking on people quickly, that would probably be a sign to the outside that, hey, you know what, things might be going okay inside.
Yeah, 100%. And like I agree as well with that 80-20 analogy or rule. I think that's spot on. I think you do get the bulk of your information from the publicly available releases. Although that being said, you would be surprised at how many people don't actually read them. Like,
Yeah.
especially come reporting season, it's really easy to open up the investor presentation when the annual report with 100 pages are sitting there beside it. It's the human intuition is just to go straight to the flashy glossy prezzo, that has all the numbers that management wants you to see. And to skip over the annual report. And look, there's some management teams who I give them credit. I think they don't shy away from the negatives of their business, and you can read the presentation and get just as good of a picture of the business as reading the report. But there's others, and you don't know until you do the work. There's others where you need to read the report. You need to really dig into the numbers and the assumptions, and to be honest, that's probably rewinding all the way back to the start of our conversation. I didn't have that background in finance and commerce. And so that's been a skill that I've really just had to learn over time of how to read a report, and in particular, how to read financial accounts. But same as what you were alluding to before with Scuttlebutt, a lot of the times, just ask people. Like it goes back to that classic, when you're in school and they say there's no stupid questions. There's no stupid questions in this game. Like, you don't make extra money because you didn't have to, ask someone a question.
Yeah.
Whatever your investment return is, your investment return is. So, I vividly remember starting out. I was DMing people, to ask questions about reports. I'll give you an example. Like, I remember the first time I came across like negative working capital businesses. It was a little business called CryoSite. It's still listed. It's CTE, I think that the ticker is. I never actually owned it, but I was just looking at it. And so this was a business that they cryo stored stem cells. So, when you had a baby, you could elect to pay CryoSite to collect stem cells. They would cryo store them for 21 years. And I think the main use case was, if you did have any sort of, genetic issues or problems, it was much easier to use the baby's own stem cells than external. I might be butchering the science behind that, so forgive me if there's anyone out there with much better knowledge of that than me. But to go back to an accounting point of view, they got all the cash up front. So I would pay, $18,000-$20,000 to these guys up front, and they would then store it over the next 20 years. And so it was the first time I came across a business model like that of, their cash receipts well outstripping the revenue and the profit they recorded. And it was confusing to me because I didn't really understand how that all worked until I read a post on a Hot Copper from someone talking about that. And I was sitting there for a while trying to get my head around the concept and what they were saying. And in the end, I'll just message this guy. So his name was Mars C. I actually don't know
Is
who.
he on Twitter?
He's on Twitter. I actually
Yeah.
don't. I've never reached out to Mars. I don't know him personally, but shout out to Mars.
Mm-hmm.
He just sort of explained to me. Maybe it wasn't a DM, maybe it was just a reply on Hot Copper. But I was sort of just asking, can you just go through that a bit more with me? And I remember early on, that's just what I was doing. I was, getting like this hands-on learning in how to read accounts, and not so much from the books or the textbooks. It was real company accounts and how it impacts them in the real world and how they manage their business. Given you've got this now massive backlog of liabilities to manage from the cash that comes in up front. And that's just continually evolved, and to the point now where I'm pretty when I open an annual report, there's very little that escapes me now. But for anybody starting out, don't be afraid to ask those questions. I mean, ask me if you want to. I'll try and answer it as best I can. But I've got
Watch
now.
out. Now you're going to have quite a few people messaging you.
Yeah, but I've got a good network of guys who they're accounting gurus, and so I had one the other week. I don't know if you saw on Twitter, but I was trying to go through Levis's report for the Oracle portfolios, and it was after the AASB 16 changes to the leases.
Mm-hmm.
And I'm sitting there for 2 hours, trying to get my head around. I'm reading the notes and reading the numbers and trying to get my head around why isn't this, reconciling or whatever it may be. And in the end, I was like, I'm just going to tweet this out. So I shot out a tweet. I was like, can anyone help me? I'm trying to, first time I've looked at a retailer post AASB 16. I'm really trying to reconcile the lease accounting. And within 10 minutes, 3 or 4 blokes had come back to me. And I had my answer half hour later, and now it all makes sense. Never be afraid to look stupid. Like I said, you don't get extra points in this game for looking smart. I've learned that the hard way too. So, ask people, use that information out there. It's one of the biggest pieces of advice I hope people take from this conversation.
I think, and it's wonderful. I think there's going to be a few major takeaways for me, Luke. One is just making sure you have that data point. We use that for not only companies in our portfolio, but companies that didn't make the cut to make sure that we made the right decision. We track them, after that decision is made. Another thing, would be that just open your mind and use these tools that are freely available to you. You mentioned Twitter. Some of the best investors I know are on Twitter, and they do more there than they do anywhere else. One question just before we come to the end, I just want to ask you, when we talk about small caps and small companies, do you tend to be quite concentrated with your own portfolios? I know Oracle's 20 to 30. Do you do something similar?
No, I'm quite concentrated.
Yeah.
So there's no fixed number, but it's usually between sort of 5 to maybe 8. But even within that, like the weightings, the top 2 or 3 could be 70 or 80% of the portfolio. And I think I didn't start that way originally. I think it's just evolved over time to where I build up the conviction in these stocks through all the stuff we've spoken about already, and I'll often sit there and I'll think to myself like, I've built up this conviction. There's always risks. Never discount the risks, obviously, but I think this is going to do really well. Why am I sitting here with 5% of my money in it? And that's the sort of reasoning I have. The caveat to that, and I've always been aware of this, and it's sort of how I not rationalize it to myself, but I'm only young. I'm 33,
Mm,
and so I know that I've got my working life ahead of me. That if I do make a big mistake, one, I want to learn from it, but two, it's not going to kill me, and so I think that has to be, you sort of have to acknowledge that as well, like where are you in your personal life to sort of run a concentrated portfolio, because what often gets overlooked is all of the great investors at one point or another went high conviction into either a great idea or
mm,
um, however they came across it, whether it be Buffett with Geico, um, you know, there's a handful of others, but they stumble across a great idea, and to really make that sort of life changing money, I guess. You've got to have the conviction to back yourself. So no, I do run more concentrated personally. Oracle, and again, Oracle, it comes back to managing. To managing the circumstances. Most of our clients are retired. They use our
mm,
emerging companies portfolio as a bit of extra growth from your typical Aussie large cap. But at the same time, these aren't clients that want to open up their account at the end of a month and see, negative 20. Um, so
mm.
that's always the factor there. But I know for me personally, I can stomach that risk, and I have stomached that risk. I mean, March for me personally was a 50% drawdown.
Yeah,
So
wow.
yeah, and you've just and to be honest, like I'll without patting myself on the back too much, I was actually pretty impressed how I handled that psychologically. I was, and I think where that came from was I understood the businesses that I owned. I actually consolidated my portfolio at that time. So I sold a couple of edge positions where I didn't have huge conviction. I was sort of just more, it looked interesting to me. And I think I pulled back to just three stocks that I knew well, and
Hmm.
obviously the market's recovered, and I've recovered much quicker. But yeah, I was actually quite impressed with psychologically how I handled that, and,
Hmm.
and and I think that can only come from understanding the businesses you're investing in. Taking a step away from the market as a financial, abstract, and looking purely at, well, what is a laser bond going to report next year, in all these different COVID circumstances.
Mm.
That was sort of how I approached that at the time.
Mm. And it's a common trait that I find amongst really good investors, to be honest, that they actually concentrate more in a downturn. So you're not the first person that said that to me. And I think obviously you only get that conviction through doing the hard work, as you say. Okay, Luke, we're pushing on an hour, and I'm hoping we can do this again, maybe in person next time. But one final question I like to ask all guests, as you know, is if you go back in time and tell yourself one thing about money, finance, or investing, what would it be?
Um, so I've been thinking about this. Like I said, I listened to your podcast, and I know the final question. I think what I would go back is, I'd say, is trust yourself earlier. And what I mean by that is I spent a lot of time early on, like years, two, three,
Mm,
4 years, um, always thinking that everyone else was significantly smarter than me. The market itself was smarter than me. And, if I saw an opportunity that looked obvious to me, um, that something must be wrong.
mm,
For me to find an obvious opportunity, that I'm missing something. And not to say I left opportunities on the table. I did, I did obviously buy stocks and do well early on. But I remember, quite vividly, a lot of times being sort of that paralysis of, why does this opportunity exist? I'm missing something. What am I missing? I've got to find it. And in the end, just not understanding that in small caps, sometimes you're just the only person looking at it, or you're
mm,
the person looking at it from a fresh set of eyes. And I still love those opportunities even today. Like I think I said to you in an email when we set this up, I mean, for me, still one of the greatest feelings I have is when I come across a report or an, a update or something like that, and it looks interesting. And when I go on to Strawman, Hot Copper, or I search for the ticker on Twitter, I don't see anyone talking about it. To me, it's still the best feeling I come across in this game.
Mm.
And so I've slowly learnt that over time is that, you know, your initial reaction is that I'm wrong, I must be missing something, when the most common answer is no, you're just the only person looking at it, or you're the only person looking at it with a fresh set of eyes that's sort of understanding the new opportunity that may be in front of you. So that's the advice I would give to myself. And to be honest, that's probably advice that a lot of new people to the industry probably need to hear as well. I'm sure
Mm.
I'm not the only person who's sort of felt that way when you're just starting out. So,
Yeah.
trust if you're doing the work, trust it. You'll often
Mm.
find it'll work out.
That resonates with me because, yeah, I mean, my early part of my career was interviewing fund managers, and I'd been investing myself for a few years. And having spoken with them and interviewed them and seen how they model companies, I was like, you know what, I'm doing this,
Yeah,
and I can do this too. Like this is something I was already doing. I thought there was some mystery wrapped around it, but that is fantastic advice. Trust yourself earlier. Luke Winchester, mate, it's been overdue this conversation, but thanks for taking the time out to just to share your wisdom with us.
yeah, no worries. I really appreciate it, and yeah, hopefully can do it again in a post-COVID world, and I can either get down to Melbourne or feel free to come up here to Newcastle. I'm by myself up here. There's if there's anyone listening from Newcastle, reach out.
That's
uh,
great, mate. I'm sure you have plenty of people reaching out after this. So yeah, and I'll make the trip up. It's a good excuse to get up the coast. So again, mate, thanks for your time today.
awesome. Thanks, Alan.